Hello, everybody. We are having another show today. Uh, Looking for my co-host. Okay, here. Hello, everybody. Congratulations, everybody. 100K Bitcoin. We did it. You know, for people that
Great timing. I
join.
hope people are not drinking too much and listen to what we say or actually show up.
Right. And, in particular for people that were here since just a second. I have like 2 or 3 things running at the same time. Where is it? Yeah, yeah. I bought my first Bitcoin in 2013, so you know how amazing and crazy this journey looks like.
Yes, I'm right at my 10-year anniversary of buying my first. I think it was certainly this quarter of 2014. So, yeah. I'm wondering if we should start with the state of the market and then we can go into the cities discussion and then go to log periodic power law. Huh?
Yeah. So we have an interesting schedule. I'm going to turn myself off because I have some background noise, but go ahead and start to describe the market and so on, please.
Well, as far as I know, and I haven't been monitoring closely, but I think this last surge happened because of some comments by Jay Powell, the chairman of the Federal Reserve, who referred to Bitcoin as digital gold while also saying it does not threaten the dollar. Now, I think many of us believe that over the long term, it may well threaten the dollar, and over the short to intermediate term, it would be wise for the US government to start considering adding some strategic Bitcoin reserve, and that may happen as early as next year or some time down the road. But I think we're probably headed towards that. But his comments appeared to have been a big trigger for the market, and also, people have been chipping away at the 100,000 wall, and now we broke that wall very good. Broke through it. We went up as high as 104. I think we're now in the 103,000 zone right now. And, my expectation is we have some momentum here up towards the 110 level anyway. And then we'll probably see some pullback. I don't know what you think, Giovanni. It's all very consistent with the power law model and with us being in, the most favorable year of the Bitcoin 4-year cycle. This is not a time to sell. This is a time to ride that rocket. Giovanni tweeted out, next stop 200,000. We expect to get to the vicinity of 200,000 sometime during next year.
Correct. Just give me one more second. I'm going to unmute myself. Go ahead and take the show over because I'm running 2 versions of the same show and there is a lot of echo in the background, so I need to fix that. I'm still learning how to use the Restream, so please take over and feel free to continue.
Yes. Well, as you know, the power law index is very steep. It's nearly the 6th power of the age of Bitcoin. And what that means is that the power law trajectory right now is in the vicinity of 43%. It does slow down with time, but that's gradual. And the total amount of new value that's created does not slow down because it's from a larger base. And with the growth that we have right now, you expect Bitcoin to double in 2-year time frame. Because we're in the favorable part of the cycle, we actually expect, the bubble to take it up and double during 2025. At some point, bubbles will break as they do, and Giovanni will talk about that in the context of the way you can model bubbles with a log periodic power law that comes from Didier Sornet and his contributors, he's developed this over many years, including modeling everything from earthquakes to, stock market prices and even Bitcoin. He's had several papers on Bitcoin itself. Before that, we want to talk a bit about why Bitcoin is more like a city than it is like even a citadel or like a company. And cities have much longer lifetimes. I've prepared a few slides, so maybe I'll go ahead and switch to that, and we'll start into that section. Let's see if I can do that. Okay. Can you see this, Giovanni? I hope people can see this. So I have a few slides on, is Bitcoin a city or a citadel or a company? And just checking, yeah, it looks good. And the motivation for this is substantially from the book by Jeffrey West called Scale, where he goes into the issues of how cities scale, how mammals scale, how companies scale. And these scaling laws are power laws. Now, here's a YouTube interview, or actually a presentation by Jeffrey West that's a little over an hour long, where he talks about this topic, especially in the context of cities and companies or corporations. And the title of it is Why Cities Keep on Growing and Corporations Always Die. So you can search for that and find that on YouTube. And these are some quotes from the beginning of his presentation. He says, it's hard to kill a city, but easy to kill a company. And he's studied this extensively, the lifetimes of companies, and others have as well. And it turns out that the mean lifetime of companies for all sizes is 10 years. We're most familiar with the largest ones. They tend to last a little longer, but even those have shorter and shorter lifetimes as we've seen more and more rapid turnover on the S&P 500 list. Cities, however, are the crucible of civilization. They are the major source of innovation and wealth creation, and they have superlinear scaling, which is why this title here is Superlinear Cities. Every week from now until 2050, 1 million new people are being added to our cities. Cities attract people because that's where the most wealth is generated, where the most innovation, the most value, the most excitement. Now, cities are meta networks. There are many, many networks that have to be in place and that develop as cities grow. And these networks are utility networks, transportation networks, and other networks related to the infrastructure. And it turns out that they scale as a power law as well. So we have our water, electricity, gas, the telephone system, cable, internet. We have the road networks, train and subways, public bus, airports, and so forth. And then we have our police, our fire, our hospitals, healthcare, and then the local administration, regulatory, and legal networks for the cities. Now, this is data that shows the power law nature of cities, and it's a log-log plot, just as we often present to you in the context of Bitcoin. There are 4 different quantities that are being measured here. Income per person for a city, the total GDP of the city, the number of patents generated, and the crime rate. So both the good and bad things increase in cities in a superlinear fashion. And you can see it almost doesn't matter which metric you choose of these 4 different metrics. They all lie along relatively similar power laws. So we have that metric being plotted in log terms on the y-axis, and we have the population of the city. It's been normalized to some standard city size, but it goes all the way up. These are US cities, so it includes New York and LA and Chicago, Houston, the largest US cities there in the upper right. And you can see that over nearly 4 orders of magnitude in population, this power law is evidenced and pursued. And it turns out the slope of that power law is not 1, it's 1.15. So this is what we call superlinear. So this is a power law of outcomes.
What is the consequence of 1.1? Can you explain to people what that means? What is why is important?
Well, what it means is that well, first of all, it's a power law, so there's some stability there from a power law. But the second is that it's super linear. So if you double in size for the city, then roughly 15% higher GDP relative to the population. So the GDP doesn't double, it goes up by a factor of 2.3. Now the inputs are sublinear, and that's all the infrastructure. That's the water lines, the electrical lines, the number of gasoline stations, the length of all the roads. That scales sublinear, and the amount of sublinear is about the same, this 0.15. So it's 0.5. Now, if you take the ratio of outcomes to inputs, then you get a power law of efficiency of the city. And this is why people end up moving to cities. They're the most efficient expressions of economy and life and culture. And so the power law of the ratio is about 1.3, about 4/3, and that's super linear efficiency for the city. So that comes from this graph comes from the talk that's on the YouTube that I just showed. So you can hear Jeffrey West talk about that there. Now, companies are quite different. They don't
It's
follow.
quite interesting, sorry to interrupt you,
Yeah,
because,
please.
for example, with the Kleber's law, right, it's also 2/3, that is, it has also sublinear scaling, and that, in a certain sense, has to do with the flow of nutrients in the blood. So it's very interesting that all the infrastructures, like the water lines, electrical lines, the water, look almost like the infrastructure of a body, right? That is has a scaling that is sublinear. That is interesting. It has interesting consequences, right?
It is, and what we call those are the terminal units. And so in your body, they're the capillaries, the smallest capillaries, and they all have to be supplied with blood. And the same thing in your nervous system. And in the cities, it's the terminal units. Well, what are those? Those are houses. So every house has to be supplied with water, electricity. It has to be alongside a road, right? And then you want it to be close to transportation networks. So these networks try to fill the entire space, fill the entire volume. And it turns out that it's more efficient to fill a larger volume. So as the number of houses and terminal networks increase, you can more efficiently fill that space with, the main arteries that you need, the wider roads, and, the 440 volt transmission lines and the substations for the electrical network. All of those become more efficient. Okay, let's move to companies. This is the history of 25,000 North American companies over 60 years of data. And this is not a log-log plot. This is a log linear plot. So a straight line here means an exponential. And pay attention to the right-hand side first. And that's the number of companies. That's the exponential curve. And it's an e to the minus 0.098 t. And, basically it's saying that if the lifetime increases by 10 years, that I drop by about one factor of e, 2.7, a little bit less than that. And it also means that the mean lifespan is an average life of 10.5 years. And you can see that even fewer of the very large companies here, but that's probably because his window was 60 years, so it's going to tail out. There have been other studies that show that, there are very few companies that survive over 100 years. They're not as large as cities. They have many ways that they can disappear. They can be acquired, they can go bankrupt, they can spin out divisions, they can go private and then die. A very low percentage survive more than 50 years. And internally, they do not benefit from superlinear scaling. Internally, in their communication networks, for example, they scale sublinearly, which is suboptimal. And just a comment about altcoins, they're much more like companies or consortiums. So whether it's Ethereum or Sol or XRP, any of these POS kinds of coins that aren't doing proof of work, they don't exhibit power law behavior. Ethereum did for a while, to some extent, before it changed its whole consensus mechanism. And once it changed its consensus mechanism, it started losing ground against Bitcoin quite noticeably. Now, Bitcoin is a meta network, just like a city is a meta network. And this is an answer from ChatGPT 01, listing some of the networks of the Bitcoin ecosystem. It includes the blockchain, of course. It includes the miners. It includes second layers like Lightning and Liquid and side chains. It includes the users, the developers, merchants who are taking payments, exchanges, very importantly, the full nodes that keep the ledger, the regulatory and legal framework and network, and the service providers network. And there are more, but ETFs fit in here. You know, companies that are adopting into their treasuries could be considered sort of another network as well. So just a reminder.
Let me stop you for a second.
Yes.
So this, first of all, this is an amazing slide. I love it because it shows that Bitcoin is not just one network, but a bunch of networks that all connect with each other, right? So it's a looping networks. This makes the system so incredibly stable, right? And there are all kinds of feedback loops, and so it's a super network that is. And I like this list because I usually mention the mining. I mentioned the user, but you're right. There is developers, there are merchants, exchanges, regulatory, all the laws, service. I will say maybe we should add the media. There is also a media network, right? Because like X, for example, I mean, that is part of the social, but then other people pick up the news, right? Like the regular media. So it's an incredible thing. And if you don't understand network ideas and principles, I think you don't understand Bitcoin. It's like that, you know, it's not a normal asset. Everybody else of it tries to give a picture of Bitcoin based on understanding traditional assets. They completely miss the point. Don't you agree?
Yeah, well, absolutely. I mean, everybody wants to go, you know, when they introduce these altcoins or NFTs or something, they're all saying they want to go viral, right? Well, what is viral? Viral means spreading with scale, right? And that's what networks allow you to do is you build up a network, and the more networks you have, the more stability, right? Because each one has its own growth attributes and they reinforce each other. So there's a statement, you know, out of ChatGPT 01 about the feedback loops. And those feedback loops are positive. They build a power law, but you can also get the runaway exponentials that we'll talk about a little later. And again, just a reminder, the difference between an exponential and a power law is substantial. Exponentials have a characteristic time, but power laws always start at time zero for the thing that you're interested in. Or, you know, distance zero if it's a 1/² gravity law or something like that. And so on a log linear plot, the exponential line is straight and the power law is curved. They can agree at some point, they can be tangential. You know, these are two fits. When the Bitcoin price was 63,000, they both go through 63,000, but only one is correct. And then on the right, the log, and there the power law is a straight line, and the exponential grows in a very unconstrained manner with constant compound annual growth. So they're very different, and it's important to understand that. So, you know, my view of Bitcoin is it's a decentralized megalopolis. It's a global city. And right now the scale is $2 trillion. And the annual value increase on trend is above 800 billion because it's growing at faster than 40%. So off this 2 trillion base, the trajectory in a year is above 800 billion. And even though that will slow on trend the following year, it will be off of a bigger base. It'll be off of a $3 trillion sort of a base, right? So it will keep growing more and more value or GDP. And right now, there are only
Did
6
we
cities.
try to put Bitcoin in this scaling of cities? That would be really cool.
Oh, yeah. Let's take a look at that. Have not.
We should try to do that, right? To put it, and maybe it's even the history of Bitcoin in different times and comparing it up with scaling of city. That will be cool. And I love this. I didn't know that New York, Tokyo, very good. This, by the way, these slides are amazing. Your slides are always beautiful. I didn't know myself that this GDP were bigger than Bitcoin. It's incredible.
It's incredible. New York, Tokyo, LA, Seoul, Paris, Chicago are the only cities in the world with a larger GDP. You know,
how big is New York? How big is New York?
New York is it's between 2 and 3 trillion.
Oh, okay. So close.
And Tokyo is like 2. So, you know, comparable to Bitcoin's market cap, if you will.
Yeah. Let's make a graph sometime.
Yeah,
cool.
We'll do that. And we can put states on there. There are only 10 US states that are larger GDP as well. So we could put the largest cities and the largest states on as well. I just looked that up this morning. Now, people talk about citadels. And of course, you can do it with countries, and people have done it with countries. But I think the city is more relevant, because this is just demonstrating that indeed Bitcoin is this kind of decentralized global megalopolis. And people like to talk about citadels, and you know, they're going to over time, that's their desire, is to have their little citadel. And there are many that are being built, and we can think of those both virtually and, you know, with real stone involved, and that will be acquired within the Bitcoin megalopolis. So some of these citadels are going to be treasuries inside of corporations, and some are going to be, you know, whales who are buying castles in Italy.
It's funny because I was looking for places like this in Italy myself, you know, because I was thinking it would be cool to actually buy a place like this. Like there are some of these towns where you can buy a house for $1, you know. And I saw even a castle for $3 million in Italy. We should buy one and make it a Bitcoin center or something.
It's coming, but remember, it's always cheaper to rent. But the houses for $1 are interesting. All you have to do is fix them up. So Bitcoin's a meta network of power laws, and ChatGPT agrees with me. While Bitcoin isn't a megalopolis in a literal sense, the metaphor works well to describe its vast, interconnected, and influential digital ecosystem. Just one slide on MicroStrategy and Mara, Similar Scientific, the other corporations that are acquiring Bitcoin for their treasuries. As they add Bitcoin to their balance sheet, they start to move away from being a purely exponential kind of network or sublinear network. They start to add some power law attribute to themselves, and some stability, some lending persistence, some longer life. MicroStrategy is already there. It's already a power law. And it's a second stage power law of that rocket, you know. It's carried up by Bitcoin, and then it provides some acceleration in a second stage. And very roughly, you know, it's not a perfect power law, but it looks like something like 4/3 or 1.36 over and above Bitcoin's power law of 5.8 or so. Bitcoin yield for MicroStrategy. Thinking about MicroStrategies in the city, their Bitcoin yield year to date is 63%, and relative to their market cap, that's like $50 billion of value creation. It's the same as Albuquerque, New Mexico's GDP. So, you know, they're starting to get up there in the city rankings. And there are now over 100 companies around the globe that are building Bitcoin reserves or citadels. And citadels are the kernels for city growth. So thank you. And with that, I'm going to pass it back to Giovanni.
Beautiful. Anybody in the audience has a question? Do you want to ask questions for Stephen?
Could a network path be like what's talked about in software book? Software book, Jason Lowery's book. Yeah, I've read software. I'm very much in agreement with his thesis. I'm not quite sure what the question is here. I think, software motivation for defense and for national and infrastructure security is another reason. Those are citadels of a different sort. You want to build that kind of a Bitcoin citadel for your utility company, for the electricity infrastructure, that you don't want to be, a victim of cyber war attacks. So it's additive, yes.
They do have a plot that I want to recreate, because I talked with Jason and he said, well, we made it, but we didn't really pay too much attention to the numbers. So maybe we can do it together, Stephen. They have a graph where they show how much energy is delivered by the weapon, and then they show on the x-axis how much energy is required to deliver the weapon. And they have what it looks like a power law, because we have a log of one quantity versus the other. I don't know if they thought or realized that it was a power law, but the moment that you draw a log on the y-axis and a log on the x-axis, and you have a straight line, it is a power law. But it will be interesting to verify that graph is actually real, and I think physicists will be the perfect people to do it, because it's all about how much kinetic energy is involved, and so it's something that we can double check.
Send me the page number if you find it or know it.
Yeah, I will DM you later. We could try to do that. But I'm also interested in putting Bitcoin in this graph, maybe historically, and see how it grows in time relatively to the cities. That will be really interesting. And do we have this other question? What will be example of citadels in New York City? Do you see this?
Well, I think the citadels here are, Penn Station is lovely, but an armory was the old idea of a citadel, right? So every city had its armory. But the new armories are in Wall Street. So I think the citadels are, BlackRock and Larry Fink building ETFs with hundreds of thousands of Bitcoin inside. Those are the Bitcoin citadels headquartered in New York City.
And can you go back to that slide that you had about the different slopes for the infrastructures versus the city itself? Can you show that slide, if you don't mind?
Okay.
Yeah. Okay. Meanwhile, if you want to ask question, you're welcome to ask more questions. So my point is this, right? And you were explaining a little bit. Let's go back and reason a little bit, because I think this will be really cool. First of all, what does it mean in general? And Jeffrey West does a very good job. But so if you have let's define what linear and superlinear and sublinear is first, and then let's explain the difference. What do you get? What are the advantages, if there are any, of having a sublinear system, in particular for things like water lines, electrical lines? Why is actually a good thing to be sublinear in this case, and why is a good thing for the city overall? So one is the input, in a sense, right? And all these outcomes, like you say, are the output. Why is good for an output like this, like for example the GDP, to be super linear, and why is good, if I understand well, I think it's actually a good thing for these things like the infrastructure to be sublinear. Why is the case?
Increasing ROI. So you have to invest in the city for all of the infrastructure, all the utilities, transportation, and other networks. That's your investment in the city. and that's growing less quickly than your outcomes grow. So your GDP for the city grows faster than that. And that means the city has a good tax base. And so it can afford not only to, help develop the common infrastructure, but it's also a good place for private companies to invest in building out that infrastructure because they're getting a good ROI. So both the private companies that build the electrical lines and the city that builds the water lines, they're both getting a good ROI in terms of the total incomes and GDP for their population.
Right.
So this is
So,
return on investment.
so for example, if a population doubles, you will expect that you need 2 times all these things. You need 2 times more water lines. You need 2 times electrical lines, gasoline station. Instead, if you take 2 to the power of 0.85, you get 1.8. And so you get a 20% discount on these things. So you double the population is only 1.8. You triple the population, right? The way you do it, you take a change. So in this case, 3 times. And then you can also, guys, you can do it at home. You take the power of 0.85 and you get 2.5. So you get a 50% discount when the population goes 3 times. You don't have to build all 3 times more infrastructure, only 2.5 times. It is incredible, right? Because it shows that given the network property of these things, there is more economy, right? For example, maybe because like the capillary in the system, right? You bring one big line to a neighborhood, and then you don't have to bring every single big line to every single person. Just bring a big pipe, and then for a short distance, you send every single pipe, right? But you need one just big giant pipe that connects all these neighborhoods. This is how you get this kind of discounts, right? Does it? Am I explaining this correctly?
Yeah,
Do you agree with that?
absolutely. You're in a profit situation, right? And you're right because your return is growing faster than your investment, and so the profit
Exactly.
is growing. And then, but what that allows you to do is to reinvest that into more advanced things, right? So then the city can say, well, I want to attract AI companies. So it can use its tax revenues to, provide some incentives to attract whatever industry or, discipline or cultural center or stadium or something that it wants, to add to its city.
Right. And the superlinear component is for the outcome. So that means, for example, if I double the population, I'm not going to get only 2 times the GDP. I'm going to get, because it's the same thing. In this case, you will get 2 times 1.15 and you get 2.21. So you get 20% more. Okay. So you actually save 20% by increasing the infrastructure, so it doesn't cost you 2 times, and the output is actually 20% more. So it's really cool. It's actually the ratio between these two numbers is where you get the improvement of having more people. So largest cities are better, more efficient. They are happier in general, right? And they can attract more investments, and it's a feedback loop like that. And Bitcoin works exactly in the same way, where, for example, we know, from the studies that I have done, the adoption grows with the cube, but then the system responds with the square of adoption. So, we don't need to get 2 times, to get, if we double the population, the adoption, the number of Bitcoiners, we get 4 times the price. If we triple the adoption, we get 9 times the price, and so on. So there are all these non-linear effects that are typical of networks, and this is why it's amazing that Bitcoin is a network. It's an incredible fact that many people should celebrate instead of resisting it, right? Because many people resist the idea, but it's a beautiful fact and has a lot of interesting consequences. We do have another question. So this is the question. Do you see it, Stephen? So is Bitcoin a cyber city with multiple utilities?
Yes, I mean, it's a cyber city with multiple networks, right? And we showed that list of about 10 different networks. And those are, some have a utility aspect, like the second layers, that's a utility, right? That allows for faster, cheaper payments. Whereas the ledger, well, is that a utility? Yes. I mean, it has a utility-like function, and it's unique. And so it's like a utility in that sense, but it's a decentralized utility. And you could analyze each one. So indeed.
Okay. Any more questions, guys? Let me check if there is any more questions. Yes, we do have one more here. Do you see the question? No, here it is. Oh, I think I missed this one.
Dealt with that one.
This is the previous one.
Yeah, we dealt with the top three on that.
Yeah, I don't see any more questions. Yeah. So, and if you guys are interested in this topic, I put a link for the talk. It's a very amazing talk. Jeffrey West made other talks that are also interesting. You can look it up, right? Jeffrey West. There was a longer one. Let's see if I can find the link. It was like, well, this one was short. So if you're interested in, yeah. So let me see. Yeah, he has this. This was a Google talk. Let me give you this link too. I will put it in the chat. It's really, really amazing. He's a very eloquent physicist. He's a physicist like me and Stephen. And he also wrote a book that is called Scale, and you can look it up on Amazon. It's a very beautiful book. Yeah, exactly. And I wanted to read you something, guys. So Taleb is this? How will you describe Taleb? Taleb is a financial mathematician.
I have a few descriptions for him. When I'm feeling spicy, I call him a risk manager. He's a philosopher of risk, one could say. And
but he has a degree in math, right? He has a PhD in math or math.
Yes,
applied math.
He's a financial math guy with a statistical focus. So he's an expert in statistics, but he does not quite bring physics kind of thinking to the way he approaches things.
True. But he does understand scale, even if at a certain point he was a Bitcoiner, and then he wrote this black paper. Maybe sometime, Stephen, we write a reply to the black paper because I
have an article on it. People can search for it.
Okay, cool. Very cool.
We can go through that article that I wrote
years
ago.
Maybe next time we go to it. We have an infinite number of topics, and it's unique. I think your presentation about the city was wonderful today. But I love one of the quotes. I have a hard copy of Scale that actually I bought a long time ago. And I really love what Taleb says about scale and the importance of scale. And I'm going to read it to you. It's each human should learn to read and write and to count. And those who know how to count should learn scalability. So this is how important he thinks it is. It's you need to learn, read, write, count, and then scalability, right? It's one of the most important skills that everybody should have. Scaling is the most important, yet most hidden and rarely discussed attribute. It's one of these things where they should teach it to children, right? To think intuitively about scale, like one of these important principles, right? And instead, it's almost like ignore. People have a really difficult time unless you are an engineer, and even more in physics, right? For us, scale is a very important concept. And says it's rarely discuss attribute without understanding it. One cannot possibly understand the word, So I really love this quote because it tells us how important this idea of scale, and power laws and scale is basically 1-to-1, right? Stephen, they are one in the same in a sense. This is why power laws are so important, because we have these scale invariant properties. Do you agree with this assessment?
Sure, absolutely. They are the expression of scale invariance. They're the mathematical expression of the concept of scale invariance.
Mm-hmm.
And what's ironic about Taleb is, Nicholas Nassim Taleb, is that he is the one who made the meme or concept of anti-fragile popular.
Correct.
He writes a lot about that.
Yes.
And Bitcoin is highly anti-fragile.
Highly anti-fragile. Because power laws are also associated with anti-fragile. And one of the reasons is because it's almost like a mosaic. That is another analogy, because sometimes it's really nice to find analogies that people can grasp and understand. A mosaic, have you ever seen this finding, in Roman houses, etc.? Everything is destroyed, all the walls are gone, and what is left is the mosaic. And they found this mosaic a lot everywhere in the Roman world, 1,000 years, 2,000 years after they were created. And the reason is because they have all these pieces, from small little pieces to larger ones, etc. So they can distribute the stress, if there is not really a unique point of failure. If there is an earthquake, if there is the earth is moving around, there is a building, more mud coming in or whatever, water, it's able to distribute the stress through all these small little, small and larger components, the entire structure as a whole, and all the different small pieces. And power laws work like that. Basically, the scalability means that there are many different things happening, both historically, but also at any point at all the different scales. And this is why you have this multiplicative effect that actually creates stability and reliability and this anti-fragile behavior. And so, again, is another amazing property. Almost all the things that many people attribute in an intuitive way to Bitcoin can be explained by the fact that it's a power law. This is why people like me and Stephen that discovered the power law in Bitcoin are so, kind of surprised that many people resist the idea. But hopefully it's one of these things that takes time, that eventually everybody will understand it, with time. What do you think? Why do you think there is so much resistance, Stephen, to this idea of a power law in Bitcoin?
Well, I think it's scientific and mathematical illiteracy is what I mean, I hate to be so extreme and sharp about it, but I don't expect people to be exposed to that degree. But everyone did learn, even in high school, they learned the inverse square law for gravity, right?
Correct.
Everybody gets exposed to that in high school. So everybody has been exposed, everybody that graduated high school has been exposed to power law in some form. What they did not probably get, though, when it was explained to them, was the scale invariant nature. They didn't really fully comprehend that.
Right. And it's not trivial. At the same time, it's not that difficult. Maybe one of these episodes, we could introduce that, right? We could introduce maybe making different examples and trying to make it as intuitive as possible. So maybe that is one of the things we should try to cover in one of these episodes. Okay, let's change a little bit topic, and still in the realm of this of the power law idea. But so this is something that
I'll be right back. Keep going.
Yeah. It's something that I have explored recently. And maybe you guys have seen some of my posts on this topic. This topic is called log periodic power laws. So it has a very similar name to the power law. It's not by coincidence, because of course we are still talking about power laws, but it's a slightly different idea, because in general the power laws that we talk about Bitcoin are overall power laws, right? Basically, we are saying the general path, the general behavior of Bitcoin is this power law. But we will have to understand how it's even possible, right, that you have a system like that, because many of these systems, like other assets, tend to be exponential, not power law. A city is a power law. So why an asset behaves more like a city? It's a very interesting question that needs to be explored. But so there is a tradition of scientists in general, mathematicians. In fact, this entire topic of statistics, I don't know if you guys know, was developed by mathematicians that were interested in gambling first. So the idea of probability, stats, right, distribution these were people who were playing dice, or they were interested in gambling in casinos, etc. And they were clever people. They knew about math, and they wanted to formalize a way of describing the probability of winning a bet, right? They understood that you could do that mathematically, and they developed this entire language of statistics. So it's really cool. There are a few books, again, in the next episode, because we go more and more in the mathematics, in the physics, of all these things. One of the books that I like is called The Physics of Wall Street, that describe all these different ideas from physics that started to be used in financial markets. And we can go through some of the chapter of the book at a certain point. But one of the most successful people that apply these ideas to the financial world, it's this person called Sornet, Didier Sornet. He's a French physicist. His background is geology. And many geologists want to understand earthquakes, for example. And earthquakes, if you think about what happened in an earthquake, basically there are materials, there are different layers of the earth that are pushing against each other. Many times this pressure creates some kind of stress. Maybe there is some kind of, maybe some magma that is working underneath. And basically, many of the one of the main tools that geophysicists use to study earthquake is the seismometer, right? So basically, it's a device that will have some component that can vibrate. It's relatively easy to make. You can make one at home. You could maybe have like an hanging magnet, and underneath the magnet there is a coil. We did this in my physics lab when I was teaching physics, like a homemade seismometer, right? You hang a magnet from some kind of a stand, and you put it in a coil. You can buy these coils easily on Amazon, and then you can connect it with something that will read the basically the electrical current that is created by the moving magnet, right? If you move a magnet nearby wires, you create an electrical current, and then you can read it. And faster the magnet moves, more current you have, right? And nowadays we have all kind of devices that can do that automatically. Your compute, there are apps, there are things that you can run on your laptop. You could do experiment and try to detect earthquakes at home. So when people study these things, they notice that just before an earthquake, before an event like that, you see these faster and faster oscillations. Basically, how we look like is you see a sine wave, and the length of a sine wave, right? Each period, usually a sine wave, a typical sine wave, has what is called the wavelength, right? That is a fixed length. But these waves will have the period becoming smaller and smaller, or the frequency. The frequency is the inverse of a period. If you could listen such a sound, I don't know if I can imitate, but it will sound like where the pitch becomes higher and higher, like this, right? It goes higher and higher, the pitch. And when it arrives to a level that is basically unsustainable, this is when you will have a critical event, right? Something like a change of phase. In this case, a crack, right? Maybe the earthquake happens at that particular time. And in fact, this approach, so physicists like very much when we can take something from a branch of physics, in this case geophysics, and then apply it to something completely different. But the mathematics, the physics behind, it's very similar. Like, for example, this particular idea that Sornet had to fit these events in this way, where you have two things. You have a power law. So just before this critical event, you will have a power law. And power law, why power law? Because power law are often associated with this change of phase. So, for example, when you have a critical phenomenon, like when we go from water to ice, right? What happens if you could zoom in the water, when you arrive to this critical temperature where very close, when the water becomes ice, you see all kinds of different things happening at all different scales. You will see, even at the molecular level, the molecules start to organize themselves in a certain way. Then you will see some bigger chunks of ice that are coming close and joining together. And then at another scale, at all the different scales, there are all these things happening. And that can actually be described like a power law. If you make a graph of many of these chunks there are versus their size, you will get a power law. So power laws are very much associated with critical phenomena, with things that tend to shift from one regime to another. And this is why it's not surprising that before a crack, before a big, large critical event, you have a power law. So we have a main power law, and then there are these oscillations, and these oscillations became faster and faster. This is why it's called log periodic. For the people that can read some math, but be patient with me because it's not too difficult. You see this equation here? This is the power law, right? By now, if you are a fan of the power law in Bitcoin, you should know that every time I take the power of something, right? So this case is a function of time. You see, I have time and I take the power. This is the power law that this model talks about, right? This is a constant, just a constant. Many times when you make this model, you allow for a constant, right? Then there is another constant. This is a multiplicative constant. And then you have this quantity in parentheses. One is time, right? So you are looking for some kind of a phenomena that can be described, at least locally, as a power law, because we have this exponent, right? When you have time to the power, like Bitcoin, right? Time to the 6, this is how Bitcoin works. In this case, this M can be whatever number. And you see there is this TC. What is this TC? This TC means that there is some critical event, right? So what matters is not much time, but the difference between this critical time and time. So you take the difference. So at a certain point, there will be this point where something special happened, right? And you're looking for the difference between this event, that is, the moment of a crash, or the moment of a earthquake, the moment of a correction in prices. Because in a moment, I will show you how we apply this idea to markets, right? That is the relevance for what is interesting to us. So you notice that this type of behavior that you can find in earthquakes, you can find in materials like NASA work with him to look for cracking materials like tanks and fuel tanks. You can apply maybe a sound, or you can make vibrate the tanks and then listen carefully at different places. If you see a sound like this that goes up in pitch, because maybe there is a crack there. And you see, and then you multiply this power law by some kind of a function, and notice cosine, right? It means that it's going to oscillate, and differently from the normal time, because usually here, if this was some kind of a normal sine or cosine, you will have a frequency. Here is the frequency of a phenomena, and then you will multiply by time. Notice, instead of multiplying by time, it's multiplied by the logarithm of time. This is where you get the faster and faster oscillation, because if you take the logarithm, the time is kind of compressed and it will go faster, right? With the given frequency, you will see this shortening of a wavelength of these oscillations. So it looks a complicated formula, but once you break it down in small pieces, like this is what I suggest all the time when you try to learn some math, always break it down in pieces. But this famous physicist called Feynman say, look, you can learn any physics, any math, just break it down in small pieces. Do one, and by the way, ChatGPT is amazing with these kind of things. You could give this formula to ChatGPT and say, can you explain me this formula, step by step? We have like an incredible opportunity. It's almost like science fiction, with ChatGPT. But hopefully you understand a little bit like what this formula is. It's basically a power law with oscillation. It becomes faster and faster. He wrote an entire book on this topic, and he has many papers. So this is another reading. If you want to read this book, there is an audio book, there is the Kindle version. But you see, the topic is complex financial systems. So this idea, like fractals, power laws, are all in this topic of complex systems. It's a branch of physics. We study these systems that are not easy to be explained with linear equations. You have to use these non-linear equations and many different tools that we develop to understand this system that for a long time physics didn't even touch. We thought we could never describe, like, for example, the weather, other complicated systems like this. Sorry for that. Now, how these things look like? They look like this. And you see, he went from earthquakes and cracks in materials to actually financial data. So he I don't know what motivated him, but maybe intuition, right? Many times this is how we work. The same thing that happened with me, where I was very familiar with the power laws. And actually, it's funny because, I did it, Stephen. I was listening with my girlfriend at the time. We were listening to this lecture from Jeffrey West about cities and power laws. And I had this intuition that Bitcoin was like a city. And I went and I downloaded, price and addresses, etc. And I started to find all these power laws. This was in 2013. I actually owned it to Jeffrey West. Sometimes you have this intuition and you say, oh, let me see, like other things that seem to grow fast and then crash, right? Everybody's familiar with bubbles, right? Financial bubbles. So you had this intuition and started to see exactly the same type of pattern. So you see the black data here will be the price. So we're talking about this HS index that is basically associated with the stock market in Hong Kong. And this is relatively old data. He has done this for a while, but he also can go in the past and see, okay, what if I was running my algorithm like if I was pretending, right, that I'm getting new data. So it's not really looking, of course, it's a little bit in the inside, right? Because that it was a crash there, but you pretend like basically back testing. You're pretending that you're dealing with new data, and so as new data come in, you're taking certain windows of information, and you're trying to find some specific oscillations that look like this, where they go. You see, hopefully you understand what I mean when I say faster, right? So it's not a full oscillation, but if you see this oscillation, right, the amplitude, not the amplitude itself, but the half period, whatever you want to call it, right, the length, the wavelength of this oscillation, it's longer than this one, right? You see, this means that things are moving faster and faster, and then this other one is even shorter. This one is even shorter. This one even shorter. And there is a point where basically they are going so fast that you don't even see anymore, right? That is where you will decide, okay, look, this thing is so crazy. I'm going to think that it's going to crash, right? It cannot go faster than that. And what are supposed to represent in terms of price? They are supposed to represent basically people being sheep. They became like a herd. So I don't know if you ever saw these videos. They are very cool. There is like a shepherd, a dog that is a shepherd dog, and he's trying to collect all the sheep. And in the beginning, they are all around, and then few of them start to be collected. And as you do that, it's faster and faster because all the other sheep tend to go where all the sheep are collecting. They see all these sheep coming together. The dogs helps a little bit, but they even tend to go there by themselves because it's actually one of these protecting mechanisms the sheep have to become like a big herd, so predator have harder time to attack them. So they know what to do in an instinctive way. The dog is basically like a wolf, right? And they react to the presence of these dogs, and they are not being eaten by the dogs, but they react in that way. And so they do it. These are going. It's almost like a snowball that it's moving faster and faster. So this is what happens with investors. They start to do things, buying and selling, faster and faster and faster until something happens and the market crashes. You see, and you see how this thing kind of predicted, because they say there is a point where the oscillations are so fast, it's a red region, where I'm expecting a crash. It cannot be faster than that. And so the guy actually made a lot of predictions on real markets. They say this is another model, right? So this will be the real data of what happened. This is the fitting with this model that goes faster and faster and faster. And at a certain point, it goes so fast and so steep that this is where you will associate the crash. And it's predictive. You can do this prediction several days ahead. And the guy was able to, this Sornet actually made a lot of money. He actually predicted real crashes. Like, see, this one is the 2008 famous crash. You could have predicted. You probably saw that movie, right? The Big Short. The guy was very clever. He used all kind of thinking about, knowledge about the market. But somebody without any of that knowledge, just looking at the data and fitting this model could have predicted the crash.
Question,
yeah.
Giovanni. How do you know when it's going to depart? I mean, this one departed, after the third mini bubble there. And how do you know whether it's going to persist to the next one or not?
How do you decide what is the critical time?
Yes.
It's basically, there is a mathematical formula. It's a question of confidence levels, right? So basically, by the time the oscillations are smaller, the time scale that you're looking. So if you're looking at days, and now the oscillations are smaller than a day, then probably this is associated. But this usually is a window, right? So you're saying it's going to be a window around this steepest component. There are details in the paper where, in fact, it goes in quite much in a lot of detail. Like, for example, by experience and by looking at a lot of these events, you will have a lot of false positive if you are not filtering things out. Like, for example, how many oscillations you need to have before you're saying that is one of these events, how steep is the curve. So there is a range of values that has been calibrated by looking at many of these events. And but we need to do something. I want to do in that because I'm still learning. I'm sharing basically what I'm learning with you guys. I knew about this for a long time, and one of these things they say one day I'm going to apply to Bitcoin, right? Because I'm so focused in understanding everything related to Bitcoin. And finally, that time came. I got the code. I'm starting to analyze the data. I'm starting to go deeper. One of the things that will be nice to do will be, the receiving operating characteristic, right, Stephen? That is basically a diagram where you draw the percentage of changing the parameters of a detector like this. You look at, by changing the parameter, how many positive detection you have versus false positive, right? And then you get some kind of a curve and you can optimize it. You say, okay, by choosing these parameters, I get a high number of detection and I minimize the false positive rate. So I need to do something like that for Bitcoin, because I'm sure every market has its own characteristics. So we need to, and what we can do one for MicroStrategy. I run the code over. It takes forever because basically it's creating all these nested windows, right? So it's creating a windows, and you can say a large is the biggest window that you want to analyze, and then it's looking for consistency of the signal over many windows, and the confidence level that you see here, basically on the right, these spikes. On one end you have a price. This is Bitcoin. Since basically the last peak, the peak of the last cycle, you can recognize, right, the pattern. Probably every Bitcoiner has this graph memorized in their head. And then on the right, you see the confidence level, right, what they call the bubble indicator. And there is one for positive and negative. Negative in this case will be the contrary, where basically it's an anti-bubble. The market is exhausted, the oscillations became slower instead of going faster, and probably that is associated with the place where the price can go up instead of down. So it's really cool that you actually can identify both tops and bottoms. And so because of all these nested windows, it's very computationally intensive. So if you look at, it took me like 4 days. I had to run these using 8 processors of my computer because it can run in parallel. It took 5 days to run all these. But if you use a small chunk of data, it's much faster. So it's much better to look at, like maybe last few months. But I wanted to see a little bit how it look historically, and you can see. So it's not super easy because of a scale that we are using here, but every of this event, it's always several days before it happened. So for example, see how it fired up when there was this big correction here, right? So it gives you a bunch of alert. It starts to go crazy when he thinks, oh, this run up. This is very similar to what is happening right now, by the way. This chunk of data is where we are right now. In fact, you see this little correction here was kind of similar to the correction that we had recently. Then there was like kind of exponential behavior. Then all these alerts that happened just before this huge big correction. Now, I want to see if I run, this is on the daily scale, I could run on the weekly scale, on the monthly scale, and then maybe in that case, we only get the huge big peaks, because it will be interesting to see both local correction, but also if we can catch global corrections, like the top of a cycle. So it did, right? It caught these, but I want to see if I can identify global versus local by using different time scales. It's something that I'm still working on. But look at these, like recent data. For example, you remember when we were in the beginning of the year, right? When the ETFs got approved, it was like at the beginning of the year, right? Is that correct, Stephen? Do you remember?
Yes, it was January, like 11th.
It was January, right? You see, and the price spiked up, right? And notice what happened. It went up. And then, in fact, if you look at the chart, it kind of reached the power law, the general power law, and then it corrected, right? And we had what we were making fun of that period. We called it the 55K gang, right? Well, it detected that. You see, look at this. Just before it happened, it detected that we went too fast up and we needed a correction. It's pretty incredible. And then kind of at the bottom of that 55K, it spiked green, and it detected that bottom. And now notice recently we have two spikes that are associated with the recent correction. So in fact, we should run it right now and see if this jumping up to, whatever we are right now. Let me check where we are right now. 103 almost, right?
103.
We can run it right now in the next few days and see if because I want to share this with my followers and on X, etc. And then next episode we can give an update if we have a correction, right? Because we are going a little bit too fast and we are excited. Can it detect it ahead of time? So this is very cool. Do you have any questions, Stephen? Or maybe we can look at even the people. I want to show you how these waveforms look like, but I can do this in a moment. First, let's see. Do you have any question about this, Stephen? Or did you have a chance yourself to study this? This work?
I have looked at it in the past. I've read several of his papers, and in the past, I've shied away from doing any modeling because it's got 6 parameters. You've got 5 that you're using. I don't know if you're using phase also. There's a phase parameter.
Mm-hmm.
Is the 6th one. So just this week, I started trying to do some simple stuff on with chat, writing code, and I will say, you have to to get convergence, you have to do 10,000, 20,000, even 40,000 iterations.
Yeah.
Just to get convergence on the parameters. I did successfully run for, I put in calendar year 2021 data for the 2021 peak. Maybe I'll share that.
Sure. I can stop sharing mine. If I can stop sharing, and we can share yours, and then I will show you more of my stuff. But first, let's see yours.
Not sharing. Let's see. It says it's sharing, but it's not.
Yeah. Do it, and then I have to give permission. So do it again.
Okay. Screen. Unable to share. Not allowed.
Unable to shoot. You're allowed.
Okay.
Try again. I saw it for a moment. I saw it. Try again. See if it works. Yes.
Okay.
Let me do it. Yeah. Go ahead. Now you have it.
Okay. So this one in the middle.
Yeah.
Sorry, it's so small, but this one in the middle is calendar year 21. So it's daily data. And, you see below it, you see the 6 parameters for the best fit.
Right.
And you see the 3 waves going into the ultimate peak, which happened a little after day 300. So it was December 2021, as we recall, right? And so it's quite successful with the first, second, and into the 3rd peak. And then, it keeps going up with these shorter and shorter oscillations. And then the price breaks down below. So I guess, I don't know where your signal is to get out. That's why I asked that question.
Yeah, we can discuss it. You have to do it in nested windows where you get different similar graphs like this. And then once you have enough of them, you pass this threshold of confidence and you get the signal.
I see.
But I can show you how to do it. But you're on the right track. It's very good that you started from scratch to do that. Yeah. It's not trivial, but it really works. Like, for example, let me show you one of my graphs. So share screen. Okay, so you see, for example, here, right? This was when we reach that 77,000, and then we got a correction, right? It was not enormous correction, but because here it's in the log scale, right? But we went from 72,000 to 55 or something like that, right? When just in March, right? March we were about 70,000, etc. And you see how the idea will be that the window that you're analyzing is from the green to the orange. And the orange is basically the day. So if we were doing this in real time, the orange will correspond to today. And then the blue line will be the continuation, right? And then usually the algo itself says, okay, I'm going to decide whether it's too fast, right? Like the oscillations we are getting are below the time frame I'm using. So for example, they are less than a day. The oscillations are faster than a day. In that case, this when you will say, okay, this is a critical event. And so you can create like a red line that represents where the critical event here. And as you can see, he got it pretty right? So it was able to tell, okay, there will be a correction here. So this is one example. And I can show you others. So it's really, I was really surprised how, see, again, it was able to detect this correction. There was the time when we reach the extension due to the ETF, and then there was this correction, and the recent one, right? Where before this jump to 100,000, we went down to 90. So it was able to detect that. It was really cool. And this is MicroStrategy, because with MicroStrategy, because of all these plays and very fast moves and power law on top of power law, I think it will be even more sensitive, right? It will be even better case. And look at this again. It was able to detect.
That's beautiful. That is beautiful.
This is very beautiful, right? It was able to detect when there was this relatively large correction. It was what, a 30% correction. All these, I did all these after the fact, because I need to be honest. Like always, I try to be honest. I didn't detect them in this real time, even if the algo pretends to do it in real time, because the window that is available in this case, even if I show what happened next, the window analyzed is only between the green and the orange. So imagine you have this. So several days before it happened, it creates the orange window, and then it tells you where it's going to be, where, and that is the red. The red is the prediction. You see?
So the question I have is, the question I would have asked is,
Yes.
well, do you get back in here? And obviously the answer to that is yes, because of today's price action. You should have been back into master already. So what does this say about how far the drop is?
I don't know yet. We need to study that. We need to see if there is a region, where you say, okay, after this region, it's reasonable to come back, right? Now, it does detect the bottom, but the bottom is much later, when things really stabilize. But I need to run it with the most recent data. I'm going to create some kind of real-time calculation. Right now, it's on the daily basis, but I'm planning to also look at smaller time scale, bigger time scales, but make a kind of almost like a monitor that we can use in real time. Now, it was funny because I was in a space with, Cardone. I like his spaces. He's a funny guy. But his spaces are also very good. He's very insightful too. And the people that come to the discussions. So I was in that space, and at a certain point, everybody was talking about XRP. And while we were talking, I say, guys, I'm going to look at, I have this new tool, based on the power law. Everybody was very skeptical. We were almost laughing about that. And I'm going to use it to make a prediction to see if actually, because right now, it looked like, it was, I didn't have a correction yet. The correction didn't happen. So it looks like one of these almost textbook examples of this log periodic power law. And I'm going to run it. And I run it, and the orange line and the red line were on top of each other, basically telling you this thing is going to correct today, it's going to correct now. And I told everybody, I posted this, right? You see, this was real-time prediction. This was actually my first real-time prediction of a correction using the log periodic power law. And I was going to sleep, and I checked because we are crazy. Last week I do a check, different prices. I check my trading view, and I noticed that XRP was correcting, and since then we had almost like 30% correction or something like that. So this was, because people can say, oh, you did all these after the fact. This was my first one in real time. And, I'm planning to create some kind of monitor and observatory where we are going to tell all the time that we are going to have events like this. We are relatively rare, but when they happen, I think the parameter I'm using are reducing false positives, so I think we are going to have a very high level of confidence when they happen. So far, all of them, even if one of them was in real time, the other two were based on, back testing, they all came true, But yeah, there are still questions. One thing would be nice to see if a confidence level corresponds to how big the correction is. So maybe we make a graph of that and see if one can predict how big the correction is and when to come back, right? Like you say. So these are some things, but it's a really cool tool. And again, this idea of scaling, of critical phenomena, of people, this idea that people cannot be modeled by math and physics is not true. We are part of nature like everything else. People have this misconception. Yeah, you can model people behavior and it works. Yeah, it's really amazing to me. What is your impression of all this, Stephen?
Oh, it is very, very interesting. It's certainly been demonstrated by Sornet that it has good predictive power across a range of applications, including the stock market. He's modeled Bitcoin as well in some detail. So I encourage more of this. I want to understand it better.
Yeah, myself included. Yeah, I want to go deeper in this, and maybe we can share results and algorithms and different tests.
I'm far behind you.
Yeah, I know that you'll catch up quickly.
Yeah.
This is good. Guys, do you have any questions about this particular idea of a log periodic power laws? Like I say, I will continue to do it and let people know if I see anything special. I'm curious, for example, about this runaway of Bitcoin that is going to happen, because usually when you have these beautiful green candles and they're exciting, some red one will follow, so maybe we can detect them ahead of time. It will be fun to do that if we can do it. So I'm going to run it with the new data, today or tomorrow. And see what the algo thinks. Any questions? Anybody? Okay. So I think we covered a lot of interesting material today. It was, I think, very productive meeting. Do you have any concluding remark, Stephen?
No, I just want to congratulate all the hodlers out there.
Absolutely.
Good day.
And it's great that we did this episode during this amazing milestone for Bitcoin.
Don't sell.
Yes. Okay, guys. Thank you so much for your participation and to be here. And I think this is one of these videos that is worth watch again, and study all the things that we discuss here. So, and we will do